It's a pleasure to be back. I was here 3 years ago, and I was dealing with a slightly sort of different presentation, but I'm glad to spend the next 20 minutes sharing with you a lot of the data related to what's going on in the market. I'm Jeff Clavier, founding partner of Uncork, one of the original seed firms in Silicon Valley. 21 years ago, I started the firm. We were called Softech at the time, and the idea was, let's be the player that helps entrepreneurs at seed stage and gets them to the next level. There wasn't anything like that. And fast forward 21 years, there's now 2,000 seed firms, so it sounds like it wasn't such a bad idea after all. And we've invested in over almost 300 companies over the years, backing a ton of successes. And we're excited to be one of the few funds that can actually lead a seed round, write a big check, and sit on the board from almost day zero. So let's get into it. First, it's pretty clear you've heard that 2025 is going to be a record year for investments. It's not yet clear we'll get to the $360 billion number we had in 2021, but clearly based on where we pace, which is roughly $80 billion per quarter, we should end up around 320, 330, which is massive. One thing which I'm still sort of trying to understand is why this number of active investors in the market is so low. It's almost at the lowest in 10 years compared to what happened in 2021. Obviously, we know that a lot of investors have left the market, crossovers aren't as active and so on and so forth. But we've basically shrunk the market of active investors by almost 60%. If you look at what's happening in pre-seed and seed, we're pretty much flat, right? Remember, 25 is only 3/4 of data compared to the other vintages, which are full year. So, we should end up roughly with the same number and amounts invested in pre-seed and seed. Sort of the same for Series A's and Series B. The major difference is here, right? This is the number of rounds over 100 million, which have reached peak levels because it's only 3/4 of data. And it feels like every day there's a multi-$100 million round in some AI company which is happening at a record-breaking pace. This is another way to look at the data. So the orange bar represents the rounds over $50 million that have closed in the first 3 quarters. And as you can see, we've never had such a long orange bar, to the point that our friends at PitchBook have to figure out another classification, because it would be interesting to drill into this data, but over 80% of the rounds were over $50 million this year. Kind of goes with the size of the rounds. The pre-money valuations have also sort of bubbled. And whether you look at the average or the median, it's the same. The number is different, obviously, but the trend is definitely similar. That's the stunning number. AI represented 1/3 of all the deals in count and 2/3 of the dollar. So almost 67% of every dollar invested in 2025 went to some kind of an AI company. It's not surprising, because when we talk to my friends and colleagues during the panel, you'll hear that everything that we look at, invest in right now, is some AI company of some sort, right? But still, the degree to which the market has moved towards AI is pretty stunning. Now, the not so good news. Exits. So you see that awesome bar that shows the $2 trillion of exits in 2021. We're nowhere near that. The glass half full view is that at least we're doing better than the last 3 years, because we're only 3 quarters into it. But it's still not great, right? We need more exits. Obviously, the fact that we've had a government shutdown that basically shut down the IPO funnel for the rest of the year isn't great. So, like, IPOs were doing reasonably well this year so far. Not a huge number, but at least pretty serious IPOs that were doing okay. And I would have said, hey, Figma did actually great, but in the last few days they tanked, so it's unfortunate. It's unsurprising they went out of lockup. Another way to look at the same sort of data is how exits have been spread across acquisitions, public listings, and buyouts. So you see that acquisitions and IPOs represented the bulk of exits so far this year. SPACs actually are on the rise for the first time in a couple of years after the absolute disaster of 22 and 23, where pretty much all the companies that SPACed in 21 sort of went bankrupt. Public markets have been bullish, so those numbers are 3 weeks old, so they don't take into account the most recent correction that we are currently going through in the public markets. But still, you see those the 12 months trailing sort of median prices, the multiples, sorry, that shows that the market have definitely sort of been more aggressive in pricing companies. It's not surprising because we sort of had a number of market tops. This is sort of a not surprising but stunning number. So those companies, the ones that are priced above 5 billion in valuation, should or could go public. They elected to continue raising capital in the private markets, so roughly 110 billion invested in those companies. And this is sort of the problem, right? We need to get more companies public in order for the public markets to take advantage of all those great innovations that we have in private companies. And we need to start moving that funnel to the public markets. The problem, and you'll see this number in a couple of slides, we have so many private companies. And at the end of the day, if we had one company or two companies go public every day, we would still not be able to do more than 1,000 listings a year. That is a really stunning number. So you've all heard of unicorns. There's a snarky version, which is papercorns. So unicorn on paper, but who knows what the real value is. So you see this continued creation of wealth or pseudo valuation that is mounting now to 3.7 trillion. As you can see, the small light blue bar is the net new number of new unicorns every year. So clearly, a lot happened in 21, 22, then less in the last few years. But it's the number of total value that is stuck in those unicorns that is really kind of interesting. This is the slide I was referring to. So this shows for you the number of private companies that are in the market at different stages, right? And that's the number now is 63,000. We've added only 3,000 last year, which obviously means that there's been a lot of companies disappearing because you have way more than 3,000 companies being seeded, by people like us at the early stage. So there is actually a lot of companies disappearing that you don't really see in the numbers. And the number on the right is basically the rate, the pace of change. You see this explosion of innovation and funding that happened in the, like from 2015 to 2020. And that rate of creation has really decelerated to, like I said, a mere 5% this last year. The problem is that we need to move those companies. So just think about like having a really efficient IPO market that could get 500 to 1,000 companies public that would barely make a dent on this private company pool. And it has to go somewhere. One major issue for limited partners, the people that entrust us with their capital so we can invest in you, is distributions. It's our ability to pay them back. And after an incredible 21, 22, it's gone down to sort of a mere 10%. So things are a bit better this year, but it's still massively problematic. You've heard a lot about secondaries. This is sort of the ability for a VC to sell a portion of their position before a company is having an exit, an outcome. And so we sell some shares to another investor. It's typically at a discount. And unfortunately, this is becoming an important sort of tool for us to use, because if we can't IPO or sell a company, then this is the way for us to create liquidity and send some cash back to our investors. That is the thing which is the scariest for the VCs in the room, is the fact that VCs so far this year have only raised about 50 billion, which is the least amount in the last 10 years. Nothing says that it's going to be getting better for the rest of the year. And so if you ask VCs that are in market right now trying to raise funds, it's really, really hard. For years, emerging managers, so I used to be an emerging manager. I was emerging until I wasn't. I guess there was like a big question as to which fund was sort of the one that decided that you were not an emerging manager anymore. We're on fund 8 at Uncork. We've stopped being an emerging manager, I think, after fund 4. Emerging managers are having a hard time right now raising and getting in business. This is sort of an interesting number. So VCs have about $300 billion sitting in their, not in their couches, but like that they can rely on, that they've raised over the years. Some of this capital is very old. Others is, capital that they just raised. And so this number will go down if VCs only raise, $75 billion this year and spend, upwards of 300, right? Think of it as the overhang represents basically 1 full year of activity right now. So it feels a lot, but it's not a lot. Okay, a few things I'm going to share with you. We're still in an economic uncertainty. Thank God we're done with the shutdown of the government, at least until the end of January. But there's still a lot of uncertainty. We have rising unemployment. A lot of companies are laying off people. That's not good. That doesn't create sort of an environment where like startups can really sort of deploy and thrive. Despite that, seed, the stage that I and my friend Eric are investing at, is extremely competitive, which means that it's expensive, because one of the ways to compete is to offer higher prices. Any stage after that is very challenging. I've been doing this for 25 years. I've done Cork for 21. And like 3-4 years ago, I could almost predict for you what a company had to show up with, to raise a Series A, a Series B, a Series C, and so on and so forth. It was almost, super easy math. Right now, it's pretty unclear. Of course, if you're one of the happy few AI companies that, start monetizing and go from 1 to 10 to 100 million, sky's the limit. You're going to raise round after round after round after round. But all the others are going to have a lot of issues trying to raise. Doesn't mean it's not going to happen, but you will take a lot of time and effort from the teams. We'll discuss this as well. What do we do therefore with our portfolio full of companies which are not AI first, which have raised capital, 5 years ago, 7 years ago, 10 years ago, and are in the tens to hundreds of millions of ARR, but have like 20, 30% growth, don't have the metrics to get to an IPO, and they have to sort of survive and grow, but not need another round because it's not clear that other round could actually sort of be there for them. There's been some M&A this year. We saw that in the numbers, but there wasn't a ton of really interesting few $100 million acquisition that you can do over and over that actually sort of does well for the portfolio, for your returns. This is where nothing is happening. You've seen some M&A happening in AI, but they've used those super bizarre partial investments with a redemption and stealing the teams or whatever, which was just a way to circumvent regulatory approval, right? And unfortunately, the new administration is not really sort of very forward in terms of supporting M&A. They're not as bad as the Biden administration, but they're definitely not as open as we would hope for. And I'll sort of finish with that one question, and we could spend 20 minutes on that, right? Are we in a bubble? I spoke to some of you yesterday, and that was one of the questions. And so the benefit of having gray hair and been around for a while is that I was there in 2000 when the bubble burst. And that bubble was based on, prices and multiples which were not realistic. The companies at the time had very, very limited sort of revenues. There was sort of clearly an overbuild of telecom assets because we're still very early in our ability to use bandwidth. And when I look at what happened then and what's happening now, I don't think that we'll run out of compute anytime soon. We actually need all this capacity which is being built. Obviously, it's kind of all those round-trip deals where you invest in me and I spend the cash with you definitely reminds us of what happened in those early 2000s. There's clearly a risk that the market has gone overdrive, and because our market is actually pretty efficient, we see this correction that we've had in the last few days that is actually sort of eating into some of those multiples. Everybody is checking NVIDIA. I'm sure some of you are, to see what they're doing with their earnings release today. But at the end of the day, as a VC who has gone through Web 1.0, Web 2.0, mobile, social, cloud, in terms of revolution, and all those massive sort of technology changes created net new opportunities to build category-defining or category-redefining companies. What we see now with AI is unprecedented. Unprecedented in terms of the change that is going to happen in every aspect of our lives and the systems that we use, but also the speed at which that those changes happen. Just think about your first impression of ChatGPT 1.0 and then 2.0 and every sort of iteration just brought innovations and abilities that you were just not expecting. One of the things that we'll discuss with the panel is what are we looking for in AI companies? And the threat to them is the fact that it feels like OpenAI and some of the others have an appetite to try and go in every sector and build everything on their own because that's what they need to capture to just justify the hundreds of billions of dollars of valuation that they have. And in order to produce gazillions of dollars, right? Pick your number, they will need to go into a lot of sectors that startups would actually hope to capture for themselves.